So welcome back. Now we'll move on to the retirement benefits now. So you have popularly there are three retirement benefits which you all need to know. Leave salary, pension and gratuity. So if you take the case of a leave salary, so basically leave salary is nothing but if the employer normally gives certain number of days as a leave to the employee. So in case if he does not use the leave, then he is paid cash equivalent to the amount of leave which he has not taken. So this is what we call it as a leave salary. Leave salary can be taken while in service, or leave salary can be also taken on resignation or retirement. So if you take leave salary while in service, then it will become fully taxable. Whereas leave salary received after resignation or retirement will be eligible for exemption. If employee is a government employee, then the entire amount becomes fully exempt from tax. If the employee is not a government employee, so then the amount exempt from tax will be least to the following. So 1, the amount which is specified by the government from time to time, which is the current amount is 3 lakhs. 10 months average salary. So leave to the credit of employee into the average salary, and obviously last one, the actual leave salary received. Now, so what is average salary here? Now the average salary for this purpose is the average of salary calculated on the basis of 10 months salary preceding the date of retirement. Again, put the stress on this particular point, date of retirement. Because even for gratuity, we use the word average salary, but for the purpose of gratuity, the average salary is calculated on the basis of 10 months salary immediately preceding the month of retirement. So in the case of a leave salary, to repeat, it will be average salary based on date of retirement. For gratuity is going to be based on preceding the month of retirement. Now what is the salary here? So like most of the provisions, salary is going to be basic plus DA forming part of salary plus commission is based on fixed percentage of turnover achieved by the employee. So whenever there is a meaning of salary, let me not touch upon this. So I will only cover those areas where the salary is different. So in other places, whenever you use the word salary, take it as basic plus DA forming part of salary plus commission based on fixed percentage of turnover achieved by the employee. Now, so in case the employer gives an entitlement of leave which is more than 30 days, then the Income Tax Act specifically provides you can take leave entitlement only up to 30 days. So for example, if the employer gives 45 days of leave for every year, for tax exemption working, you should use only 30 days. So if you receive leave salary from more than one employer, 3 lakhs is your maximum exemption. So similarly, if you already work with one employer, resign there, join another employer, but your exemption from both the employers cannot be more than 3 lakhs. So to ensure that you don't miss on this particular point, whenever an employee resigns and already has got exemption for leave salary, reduce that amount from 3 lakhs so that you can always capture this particular point. So now moving on from leave salary to gratuity. For the purpose of gratuity, the employees are classified into 3 categories. 1, employees who are covered by Payment of Gratuity Act, employees who are not covered by Payment of Gratuity Act, and others. So in the case of government employees. So in the case of a government employees, so gratuity will be fully exempt from tax. So in the case of a non-government employees, and if it is covered by POG Act, the amount exempt from tax will be 1, 10 lakhs, 15 by 26 into salary lost on into complete area of service, a part thereof in excess of 6 months, gratuity actually received. Now, in case if the employee leaves the job before 24th May 2010, that is he leaves or retires by 23rd May 2010, then the exemption will be restricted to 3,50,000. So the increased limit will apply only from 24th of May. So in the case of a non-government employees, everything is same except for instead of 15 days salary, it is going to be worked out on the basis of half a month's salary into the average salary into completed year of service. To completely go through the provisions, 10 lakhs actual receipt, 1/2 into average salary into completed year of service. A couple of interesting points which you can note here. In the case of persons who are covered by Payment of Gratuity Act, you round it off in excess of 6 months. If it is 15 years and 7 months, take it as 16. If it is not covered by Payment of Gratuity Act, and if you work for the same 15 years and 7 months, you will take the completed service which is only 15 and should not be rounded off to 16. Whereas salary for the purpose of persons covered by POG Act is only basic plus DA. Whereas if you are not covered by POG Act, it is going to be basic plus DA forming part of salary plus commission based on fixed percentage of turnover achieved by the employee. Now, the next and the most important point, for the purpose of Persons Covered by POG Act, you divide the salary of 15 days by 26 being the maximum possible working days in a month. Whereas if you're not covered by POG Act, you don't use 15 by 26, you do 1 by 2 because the provisions clearly say it as a half a month salary. So these are some very important points we need to take into, like what is observed in the case of a leave salary. So the 10 lakhs or 3 lakhs 50,000 is a lifetime exemption. Therefore, whenever the SSC or employee already gets exemption earlier year, ensure that you subtract from this provision so that you capture this particular point. So 3.5 and 10 are lifetime exemptions available to an employee. Moving to the last of the important retirement benefit, which is pension. Now basically a pension is a periodical amount paid by the employer to the employee after his retirement. However, the employees can also, instead of receiving pension on a monthly basis, take it as a lump sum amount. When you receive it periodically, it is called as uncommuted pension. So if you receive the pension on a lump sum basis, then it is going to be called as commuted pension. If the pension is received on a monthly basis, that is, if it is uncommuted pension, it is going to be taxable for all employees, whether they are government employees or not. However, in case if the pension is commuted and if the employee happens to be a government employee, then the entire pension is fully exempt from tax. What if the employee is not a government employee? In such circumstances, the amount exempt from tax will depend upon whether the employee is also in receipt of gratuity or not. If he is also entitled to gratuity, the exemption will be 1 by 3 into the full value of pension. If he is not in receipt of gratuity, then the exemption will be 1 by 2 of the full value of pension. The most important key point which you need to note here, exemption of 1 by 3 or 1 by 2 are calculated on the full value of pension. So what do you mean by full value of pension? So as I already told you, you can either take it as periodical, or you can take it as lump sum, or you can take it as partly periodical, partly lump sum. Let's for a moment assume an employee takes 60% of his pension for 1,20,000. Now this 1/3 or 1 by 2 is not calculated on 120. So instead what you should do is, you should first make this 120 into full value. That is what will be the commuted pension if entire pension is commuted. If 1,20,000 is 60%, 100% will be 2 lakhs. Now this 1/3 or 1/2 is worked out only on 2 lakhs. Now this is the most important point you must observe. That one more point which you need to observe here. Once you take 60% of the pension as lump sum, your periodical pension is no longer going to be the same amount. You will only get 40% of your existing uncommuted pension henceforth as your uncommuted pension. Now these are some of the points which are generally missed out in the examination. So there are other retirement benefits are also there, like retrenchment compensation, VRS. You can go through that. So those are the provisions which may not be there in every examination, but however, just have one run through of it, that should be sufficient. So from retirement benefits, the next thing what we are going to move on is the most important provision in salaries, which is going to be perquisites. After perquisites, we'll have PF and deductions covered in the coming videos. Thank you very much. Watch out for the other videos. Bye.